Hey, if you're like most people, you've heard of LEAPS options but don't really know what they are. In this video, we're going to discuss the two most important factors about LEAPS options. We're going to discuss what are LEAPS options, how do they work, buying LEAPS options versus buying stocks outright, when is the best time to put on LEAPS options, and most importantly, the two most critical factors when buying LEAPS options. Stay tuned. Also, be sure and log into www.darrensteves.com or optionsfinanceprofits.com and get the free training on options. So what are LEAPS options and how does the strategy work? LEAPS options are long-term options that have an expiration date that is further out than traditional options. The name LEAPS stands for Long-Term Equity Anticipation Securities. LEAPS options were created in 1990 to give investors the ability to trade options within a longer time frame. How do they work? LEAPS options is a great way to be involved in the market without having to tie up a lot of capital. When you buy LEAPS options, you're paying for the right to buy a stock at a set price, the strike price, at some point in the future, which is the expiration date. When you buy LEAPS options, you're paying for the right to buy a stock at a set strike price at some point in the future. When you buy stocks outright, you're paying the full market price for the stock and own it immediately. Buying LEAPS options allows you to control a larger number of shares, much less money up front. The cost of the LEAPS options is the maximum amount of money that you can lose if the stock price goes down. So buying LEAPS is a defined risk trade. Buying the stock outright costs much more upfront, more than double, and is also riskier since you can lose much more if the stock does move down in price. So when is the best time to use LEAPS options? The LEAPS option strategy is most effective when you are bullish on a stock and expect the price to rise over the long term. A down market or bear market is often the best time to start buying LEAPS options. This is because the stock prices are usually depressed during these times and you can get a deal for the LEAPS options. Let's look at the two most critical factors when buying LEAPS options: time value and intrinsic value. Time value is the amount of time until the expiration date of the option contract. The longer the period until expiration, the higher the time value. Intrinsic value is the difference between the strike price of the LEAPS option and the current price of the underlying stock. If the stock price is below the strike price, then there is no intrinsic value. When buying LEAPS options, we want to go deep in the money and as far out in time as possible. The best way to demonstrate why this is the case is to actually show you on the Tastyworks trade platform. Let's take a look at buying a LEAPS option in Palantir. It is a solid stock expected to grow, but it's been caught up in the overall market downturn. The stock price is currently 10 and it's been as high as 29 within the last year. So we go 547 days to expiration and the January 2024 call options. We go this far out in time so that we have plenty of time for the stock to increase in price. We pick the deep in the money $5 strike since it has $5 in intrinsic value already. In other words, the stock currently at 10, there is already $5 in our favor built into the trade. So we can easily look at it as costing us just $1.10, which is the $6.10 cost to put on the trade minus the $5 intrinsic value that is built into the trade. This is a great deal because the stock only needs to move up $1 before we start making money. and at this point it closely replicates owning 100 shares of Palantir outright. If the stock gets back to the $29 range where it was at in September, then we make about $1,800, or $2,900 minus the $1,100. How do we manage the LEAPS option strategy? There are different theories on managing LEAPS options trades. I'll give you a couple of different methods that are commonly used. Then I'll tell you which one I like to do. The first method is to set a price target for the stock and sell the LEAPS call option when the stock hits your target price. This will allow you to lock in the profits and avoid letting the trade run against you. The second option is to hold the LEAPS option until it expires. This is a more aggressive approach and it leads to a bigger growth and bigger profits if the stock continues to go up in price. However, it also carries more risk because you're letting the trade ride. I like to use a combination of both methods. I'll set the price target for the stock and hold on to the option until it hits my target. Then I'll also sell half of my position at my target price to lock in some of the profits. This way I have some downside protection if the stock reverses course, but I still have a chance to make big profits if the stock continues to increase in price. There is another way to manage LEAPS options. This is something that I consider if I'm bullish on the stock and the price move up has not yet occurred, and we're already at 352 days to expiration, or the 1-year mark. This is the time when the value will start to decline rapidly. Remember, the time value is the amount of time until the expiration date of the options contract. The longer the period until expiration, the higher the time value. If we're at 352 days, the extra cost to push the LEAPS option out and give yourself another full year is usually very small. It typically costs 30 cents or so on a $10 option. In other words, $30 on a $1,000 option contract. So you will sell to close the current 1-year LEAPS option and buy to open a new LEAPS option contract 1 year further out, or around 2 years out. This is nothing in the scheme of things. It may increase in value in the next month right after you did this. However, the increase in value of the option will still be high and will more than make up for the $30 investment to keep the LEAPS option on without being subject to the decaying time value. LEAPS options are a great way to get involved in a stock without having to put up a lot of money. They also give you the chance to make big profits if the stock price goes up. Just be sure to pick the deep in the money strike price and go as far out in time as possible. 1 year versus 2 is normally $20 or $30, so just go 2 years. And be sure to have a plan for managing your trade. Do you trade LEAPS options? What's your favorite strategy? Let me know in the comments below. Also, thanks for watching and be sure and hit the like and subscribe buttons below. Have a great day.